Tony, what are the macro themes shaping private market investment in 2026 and I guess beyond?
Yeah, we're looking at a lot of the same sort of factors that you're looking at in the traditional markets, although in the private markets, I'd say there's a couple nuances. One, we're looking at the liquidity in private equity. We're looking at the spreads in private credit. Some of the spreads are starting to come down. And then in real estate, we're looking at valuations.
What are the most compelling opportunities? You named a few places that people can invest. What's the juiciest right now?
Yeah, I'd say probably the highest conviction idea that we have is private equity secondaries. We think there's been this supply-demand imbalance for the last couple of years. We think secondaries look attractive as institutions are seeking liquidity, getting out of their private equity positions. By the way, for individual investors, that's a really attractive place because it provides a lot of built-in benefits, better diversification, shorten the J-curve, allocating across vintages. So that looks really attractive to us.
You know what, another good place for individual investors to put their money in the past 3 years is in the stock market or in the NASDAQ. The indexes publicly traded have done awfully well. So why should an investor want to go private now?
I think over the long run, there has been this long-term illiquidity premium, that excess return that you get for allocating to the private markets. I'd also, as we think about it, the last 3 years have been very strong in the traditional markets, but that is not the norm. The long-term average is obviously much lower. So our overall view from Franklin Templeton Institute is we think equity returns are likely to be a little bit more muted than they've been the last 3 years. We think private markets represent a rich opportunity set.
And what role do they play in a client portfolio? Is it to lower the risk? Because there is a liquidity cost, and a lot of times they're a more costly investment as well.
Yeah, I think it's a great question because I think sometimes we paint everything with the same brush. So I'd argue private equity is in the portfolio to get incremental returns. We think about adding private credit because we want to get more income in our portfolios, dampen the volatility. Real estate is kind of this unique investment that provides both growth and income, but also low to negative correlation to traditional investment. So think about your shock absorber as we have shocks in the system.
Can you talk about manager selection? Because as the private market, if you will, has grown, seems like everyone's now a manager of private assets, and people can be led astray.
Yeah, I think that's one of our key themes coming into 2026. We came out with our private market outlook, and one of the underlying themes is we do believe that manager selection will matter a lot. Allocating capital to seasoned managers who have managed through good times and bad are likely to do much better. But to your point, a lot of money has come into the space. There are newer managers who are chasing where the opportunities are. If you haven't managed through good times and bad, you're likely to have a very different experience.
And then finally, last year was yet another big year of money moving into this space. So what inning are we in, if you will, when it comes to money moving into private market assets? Because for a long time, it was just the endowments, it was just the colleges and the institutions that had the ability to invest in private market assets. Now everyone can do it, but has it been overrun already?
I think it's still very early innings. You know, as an industry, we're roughly a 5% allocation to alternative broadly. Private markets might be a 2 to 3% allocation. As you mentioned, endowments and foundations are 30, 40, 50%. I think we're in the early innings in the wealth channel. I'd say third or fourth inning. We have a long ways to go, a lot of great opportunities in front of us.
All right, well, thanks for coming on and talking about it.
Always great to see you, Greg.